Hey, everybody. Sorry for the delay. Appreciate you being here. Technology is amazing. It's so easy to, do these when I record them, behind the scenes, usually Thursday or Friday. Thank you very much for taking the time to be here. I'm very humbled by, everybody and their comments. I read everyone. It means a lot to me. I made a promise to God basically when I was struggling, which I'm going to get into today. And said, my goodness, there was no internet. There was basically books and people. And the people were like, by asking them for help, they almost kind of felt like I was trying to get their job. That was the vibe that they gave off. And so, here it is. It's me and my damn red Dalmatian. And just remember, just because you've never seen a red Dalmatian doesn't mean red Dalmatians don't exist. They actually do exist. It's a genetic mutation. It's more brown than red, but we're not here to talk about Dalmatians and their damn red spots. So again, thank you so much. I appreciate your engagement on the channel. It's a labor of love. I do have some resentment. The damn channel's an enormous amount of work. I have a team of people who help me. Good to see you. I recognize a lot of the names. Hi, Jess. Hope you're doing well. Thanks, everybody. Robert, appreciate you being here. Transylvania, that's awesome. Matt from New Mexico, Texas on the map. Love Texas. Texas and New Yorkers, they get along very, very well. Israel, Lansdale, how's it going? Appreciate everyone being here. I have a friend of mine who's helping doing the moderation. So, because like any joint, we have a no a-hole rule and we don't deal with comment spam. But anyway, New York City in the house. How about go Rangers? How about that second overtime and the Yankees doing a little ass whipping on Houston? I love Texas, and I love Pearland. As far as baseball's concerned, it's a thumbs down. CT, how are you? I'm from Carmel, New York, and I'm 15 minutes from Danbury, Connecticut. So spent a lot of time on 84. Played a lot of ice hockey in Connecticut against some really damn good schools. Anyway, this is all considered throat clearing as far as broadcasting is concerned, and I know time is very valuable. So what I want to do is kind of get right to the Johnny McGorry. I can see the questions in the chat, so I'll try to answer them on the fly, but it's kind of hard to have my eye, doing both. So let me go to my OBS here and go share screen. And, whoops, I got to change the window there. Hang on a second. Let me go here. This one. Can you see all that? No. Can you all see that? Let me get to the... Let me see. There we are. Sorry, folks. It's just me and my dad and the dog. So what I realized when I was starting out was that it was very, very difficult to... I didn't have any money, right? I was a BAB, a broke-ass biatch. And I was afraid to lose that 'cause there were no funding accounts in those days. So if I lost all my marbles, I was kind of screwed. Having said that, I needed to find a way to get big, but without being big at the very beginning, because in those days, commissions were very high, stocks traded in eighths, the bid-ask spread in futures were reasonable, the volatility was low, prices were lower, so margins were lower. So you could get a lot of bang for your buck. So I took my 5K, what I did is I divided it up, 2,500, basically put 2,500 into stocks, and I did another 2,500 in futures. Now, under Reg T, this allowed me to trade up to 5K in stocks, and then this number was more like, okay, 2,500, if I maxed it out, that would be like 5% of what, right? So you have to figure that would give me ultimately, between 40 and 50K of notional value, right? Because think of it like real estate. If I bought a $500,000 house and I put down 100K, 20%, and the house eventually went up in value by 20% to 600K, then I sold it. I'd have 400 left on the mortgage, but I'd net, 200. My 100 down payment plus another 100 in growth. So I was always very aware that with futures and with leverage, I could amplify, my rates of return and basically go and grow my cash. So I didn't think about trying to gigantically move my own account. I thought about trying to increase the notional value, like the house. What could I do to improve my house along the way so that my account would grow accordingly? So I kind of broke up my money, and then I figured, okay, what did I need to do to really grow, to grow my own loot? And that was very trying. That was very, very trying because I wanted to get to 50K, and that was not an ego thing. Because what did I know about 10X? At that point in time, I had basically been a day player. So I broke it down and said, okay, if I need to get to 50K, what's that journey going to look like? So I kept thinking, and I used reverse engineered how they would say, if you're down, 20%, you need 25% to get back. If you were down, a third, then you need 50% to get back to where you were. So I started thinking about that math and how I could kind of chunk my way to my future. Why? Because I didn't have a lot of breathing room. Long story short, I knew I couldn't. It's very difficult to pay your bills out of your trading account. So if you're trying to do that, I'm going to be the guy to give you a dose of reality and say you're better off taking out the cash, putting that in a separate savings account, and then trying to trade. Because in 36 years, I don't know a single person who's done that. No hard feelings. If you can bang it out, more power to you. But anyway, I thought, okay, with a smaller account, if you catch a good move, it's not unlikely that you could grow 50%. So then I just started thinking okay, so then if I passed the ball and grew my money, whoops, you can't see this. What a jerk. So here's the 50K. Sorry about that. Rookie mistakes. So if I grew my money 50%, I'd be at 7,500, a little breathing room, nothing to click your heels about or to, write to Santa. Then 33% above, that's 10K. So I really thought about doubling my account is one move of 50% and then a 33% rate of return on top of that. Because I couldn't think of 10X. I didn't know what the hell that meant. And then 25% would take me here. So you notice I'm not putting a lot of pressure on myself. I'm actually going down. Then the last move is 10% up. And now all of a sudden I'm at 3 times where I started. The goal was to get to 50 because I wanted to take out like 5 or 6K and put that into a separate savings account because I started every month like 2,500 in the hole. I had the month after commencement at Columbia, I had $1,000 a month in student loans. And thank God that I paid for 2 years cash from having sold a business. I still had to borrow money for year 2. I got some scholarship money. It wasn't a lot. It was like, I don't know. I can't remember. I think 8 or 10K academic scholarship. But, it's very expensive to live in Manhattan. Plus, student housing wasn't cheap. I lived off campus. That was $500 a month for that. So I had New York City. So when I got to Wall Street, I had $1,000 a month in student loans. I had $1,000 a month in rent. And then I had living expenses. And don't forget, in New York City, you have a federal tax, a state tax, but you also have a city or a borough income tax. So I was getting smashed three ways till Sunday. And then, okay, so then I kept bringing, this is just an example of how I thought I could get from 5 to 50 by getting incremental, compounded growth at varying rates to get where I want to be. I forgot to say a couple things at the top of the market. This presentation here, let me go back to the camera. So this presentation today is mostly for beginners who are struggling and who are trying to figure it out. If you're already succeeding as a scalper or a day trader or trend follower, it doesn't matter to me what you do. It's your life. This might be frustrating for you because you probably know this. You might have already mastered it. I'm kind of just helping out the folks who are at the early stages and they're trying to figure it out. They're trying to get to a point of consistency because once I got to the point of consistency, that I knew I could twist and shout and make a lot of money. We're not going to really read charts here today. It's not about that. You make your money on position sizing, so that's really what we're going to talk about. You don't want to be biased and say, like, I love crypto, I love NVIDIA, the earnings are coming up, I'm going to bet the ranch. You really want to go back. I think I actually did a YouTube video a week ago Monday that talked about benefits of constant bet sizing. This model that I'm going to show you, like on how to manage risk, it might be high in frustration, but it's also going to be higher equity. So if you're a person who wants to operate with like Swiss watch efficiency, this might get under your skin. I admit that. There's caveats to everything, right? So that's what life's about, choosing what these trade-offs are. From a risk management legal disclosure, I got to tell you, I'm not a financial advisor. I'm familiar with your names, but I don't know what your situation is. I presume you've spoken to a financial advisor to figure out that trading's appropriate for you. Trading's very risky. I trade with a lot of leverage. That's not appropriate for the majority of people. You really need to know what the hell you're doing. If your account is underfunded, you can see very, very gigantic swings in your account. Leverage can kill you, and most people fail at day trading. So as long as you know that and you want to stay on the show, whatever happens after this is really on you. But nonetheless, I had to use a lot of leverage to get where I wanted to be because I wanted to, my job was to grow and amplify my cash. The total return on the S&P when I started was about 12.25%, including dividends. And so I had 5K. What did I care about $600? It didn't pay for a month of rent, and it didn't pay for any student loans. It didn't make a dent. So I knew I needed to really go completely white collar and amplify my cash and use the leverage to my advantage. So I had to kind of think, and back in those days, we had charts and they looked like this. The candlesticks had really only become popular right after the crash of '87. So when I started, they were like only a couple years in popularity, which was basically no popularity. So all we really ever saw were open, high, low, closed bars. Now, whatever this chart is, it doesn't matter what the hell it is. Bar chart lets me use it for free as long as I disclose it's from bar chart. And you can also get these charts for free. I don't have any conflicts of interest. They don't pay me for anything. I don't refer them business, but it's a place where you can get charts for free. So I would notice that the ultimate move was down and it was consistent. But I also noticed that there were days where it was going up and down. Like it was going down, but in an up and down manner, right? So it would sell off and then it would kind of consolidate and would sell off again. And I kept thinking to myself, what the hell is it that I have to live through in order to be here? Because if I could sell the thing short at this breakdown and say 490, and hold it maybe not to the absolute bottom, what would that look like in my equity? And I can show you, how I built out, this spreadsheet. I'm going to go all over it. But the first thing I needed to do was to figure out what the damn position size was. Again, I was trading mostly Dow Jones Industrial Average, the 30, large cap stocks that make up the Dow in my equity trading because I was too stupid to know whether anything was high quality or not. And so I figured, hey, if I go listed and stay listed, they're marginable by definition, which is great because I need to trade like I've got 5K. I maxed that out. They also have a lot of clout in that they have size. They can acquire other companies. They can cut costs. They can lay people off. They have a lot more room to improve the earnings, where startups are cash strapped. They don't have the same type of resources. Because again, in those days, we didn't have there was no venture capital or private equity. It was a small little industry. Now it's gone berserk. But at the end of the day, I had to figure like, okay, if I was going to get in, I know this says buy, but I was primarily long. I would think to myself like, if I got in one risk unit of say corn or any of the grains at a particular price like 430, a 3-cent move was $150, which was a 3% move against my account. So I had to pick my R, right? That was a discretionary type of situation. And I put my stops in very, very tight. That's where the frustration comes in. Because you can pick your spots for your stops. You typically want to make them based on volatility. But at the end of the day, you really want to make sure that because I didn't have the money to lose. And I knew if I blew up, not from being stupid, but if an adverse thing happened, right? Because I'm not reckless. I'm impulsive. I was at the time. but I wasn't going to get smashed. And then I said, okay, what would that look like if I put that position on? And then I marked everything to the market, and I literally went into the chart, this chart, and I'd hover the mouse and I'd say, okay, here's the data, the open, high, low, close for this day, and I'd write it down in the spreadsheet. Then I'd go to the next day and I'd do that, and that looked like this because we didn't have backtesting software. So I'd say, okay, if I had one contract and the thing opened here, this is what my equity would have looked like, or this would be the impact of the move on my account balance at each of these inflection points, the open, high, low, close. I didn't really care about what happened. So it gives you the best and the worst of it on any given day. And then I could say, okay, if my account was at 5,000, here's where it would have, here's the effect on my equity. And then I would work it out and say, okay, obviously, this is all hypothetical here, but if it was like down 10%, then I looked at the overnight risk, because a lot of people have fear about overnight over the weekend. I myself don't. That's where I tend to make all my money. And I looked at like what the impact of that was so that I could process my feelings around my risk management. It wasn't so much like what money could I make. It was like you have to plan your trading strategies and tailor it to the drawdown. Because everybody and my dead grandmother can see that there's a move underway here. The question is, how much can you live with the counter trend moves? You like these big pronounced moves, but the hair trigger response is to take the trade off here, where in a lot of ways I kind of think like, okay, we're just getting started, especially if it closes at the bottom. So what I learned how to do was to say, I need to add to my winners, because even 10-cent move is $500. That's 10% to my account. I always thought in terms of percentages. And I said, I really need to get to 50 so that I could pinch off 5-6K, put it in the savings account, and then I'll grow the rest. But now I won't be, it's not like I was trading with scared money, but I only had like 2 or 3 months of cash in a bank account to cover my bills. I really didn't have anybody who I could borrow money from. So it's like that story they say about, being in Africa, hang on a second. You have the right sheet here. Yeah. Okay. So at the end of the day, it's like I had to figure out where my risk was going to be. At the end of the day, I would add to my winner at 2 or 3 cents above where I got in, but then I would adjust my protective stop accordingly to the damn entry price. So at any given moment, I only had $150 or 3% risk, even though I was getting fully loaded. Does that make sense? So then I would, if I could get to a third entry at 2 or 3 cents above, as the move was going in my favor, right, I could get to a point where I was at, say, 433. But the interesting part, when you get to this entire structure, okay, I'm looking at this whole structure is basically a break even. It's a free call option. So I'm going to lose 3 cents here. I'm going to break even here. I'm going to make 3 cents here. So this is really where I was trying to get to. I wasn't worried about the first, the first position, so to speak, in the Johnny Magori. I was trying to get to that spot where I could have several positions on at the same time, and then, go from there. Let me take a second and see what's going on. I want to make sure, because I'm doing this by myself here. When I look at this. Okay. Well, it's showing you the whole screen. Sorry about that, but I don't have anyone to help me with it in the meantime. So the point is that I needed to find a way to kind of rob from Peter to pay Paul and go and get on, get fully loaded and get what I would call like a free call option. And that was the way I fully loaded my account, setting my stops, investing my gains into my protective stops, so that if the market took off and ran away, I wouldn't. I'd have enough of a position on where it could make a difference. Because you got to remember, the commissions were very, very high, and so, getting stopped out of trades and getting knocked out was expensive, because you'd lose money, but you'd also lose the commission. You see, so that was a pain in the ass. Now, by the time I got to having my third risk unit on, I would have, 3-cent loss on the third piece. The break even would be here, and then my initial piece would make me money, but I'd have 3 contracts. So then if the thing kind of took off for me, it was gigantic windfall cash. That's how I was trying to get to the 75 to the 10. Now, if I could get to the fourth unit and then some, where the current market value was 39, even here, when you get to 39, what you're really doing is shifting that break-even structure a ratchet higher. So now it's like, if I get stopped at 36, I'll lose 3 cents on my fourth, I'll break even on 3, and I'll make 3 cents on 2. But because I kept buying into the winners, I would have that winner here, which would have been whatever it is, 6 cents, $300 on my, on my account. Now, this is not pyramiding. This is just adding to winners. Why? Well, in those days, prices were low and margins were low. And so at the end of the day, I was not worried about, I was not using what we call excess equity. So the unrealized gains that I would have from each of these successive positions, I wasn't using that to acquire more product. I had the cash available because the margin was like $200-$300 a contract, something like that. So, and the prices were lower. I think corn was like $1.90 at the time. But you can do this with stocks as well. But notice I'm entering and I'm exiting with stops. I'm not chasing. Price is the trigger that gets you into, the scenario. Now, many of you are like, Mike, the thing is up 3% already, like 3-4% here. That's what I'm selling. And I think that's part of the problem of why you might be struggling, is because you need to figure out, what it is that you're working for. For me, I had already done blue collar despair. I had worked for the mafia in Italian restaurant, Westchester County. I had worked at Wingfoot and Quaker Ridge, caddy and golf bags. I had a landscaping company. So hard work wasn't the problem. I needed to learn how to work as in a white collar job and not kind of turn it into, blue collar despair. And live my life as a Raymond Carver short story. So I would take those positions then and mark everything to the market and say, if I want to amplify my account, I have to take a look, and I'd say, okay, here's Tuesday, here's Wednesday, here's Thursday, here's Friday. These are all made up numbers, but you get the point. It's like I would see at each of those inflection points what was going on, with my overall equity, and why would I fall to pieces if I had a $400 retracement. Again, so let's define a few things. To me, pyramiding is when you use excess equity from an open trade, right? And you're using that to, amplify your positions. I was using the implied leverage that goes with futures, but I wasn't going above and beyond that. To me, that's the traditional definition of pyramiding. This is just adding to my winners at very close prices so that I could, if it did kind of take off, I would get fully loaded, very, very quickly, and then let the market move in my favor. This model will frustrate you because of the tightness of your stops. So if you don't like the feeling of frustration, that's all great. But, if you're not making money, something's going to have to change. If you remember how I say, sometimes the feelings that you want to feel are on the other side, of the ones that you don't. So then I was very keen on knowing like my expected values. And I started thinking like, okay, if I made 450, everyone's thinking 3-1, like these numbers just don't add up. I mean, that now they might add up because there's no commissions basically, but at the end of the day, hang on. No, SD, they were not on the ATR. The ATR was published in a book in 1978. And although I worked with a lot of Hayden Stone guys, who knew who Wells Wilder was and had were friends with him. This is kind of long before that kind of became popular. No one was really talking about it at all. This was just me picking a number based on volatility and what I could afford to lose in my account, where I could afford to say take 3% if I was making 10, 12, 15%. Again, because with a smaller account, smaller moves can still really pump your account up. But I did have a good sense of timing, so I found that I was in the right trades. I just had to figure out what was the right way to position size. And because my account was so small and there were no micro or mini contracts, the ES didn't exist for like 6 years or so until after I started. And when I started, the margin on the S&P 500, it was $500 a point, not 50. They cut it by 90%. So the contract that you see with the ES is 1/10 the size of the Big Daddy, which when I started was 40,000 in margin and $500 a point. There was another one that, for whatever reason, it was 250 a point. I guess that was the mini, but for whatever reason, it didn't trade as much. So to me, it was like the S&P 500 was an institutional product because it was really for hedge funds and portfolio managers. They needed to find a way to turn it into a retail product. So at the end of the day, I was aware of my winner to loser ratio because I was good at math. I could do a lot of this in my head, and I couldn't. It's very hard to increase your accuracy. I know you want to go to indicators, but they really don't work in many ways. They're kind of like emotional band-aids that kind of help you feel good, but the price really tells you the truth. My friend Brian says, only price pays. And to me, it's like everything else is a derivative of price, so I don't need to look at that derivative when I can just look at the price itself and see what it's trying to tell me. So nonetheless, I would look at the expected value and say like, oh my God, here's 3-to-1 with what I could afford to lose. You could see I'm going nowhere fast. You know what I'm saying? No, there's no target vol. I'll show you something in a minute, Daniel, from New York City. Give me a second here, though. I don't want to lose. Sometimes I talk so fast I go on tangents because I don't remember where I left off. So, yeah. Yes, Dakota, only price pays is good. I think I have actually 2 interviews that I did with Brian Shannon on the YouTube channel. So I knew that I had to beef this up. This was non-negotiable. I couldn't really increase this to 250. I wasn't comfortable taking 5% risk units, at least when I started. And this whole process took me about 2 years to kind of figure it out. So it wasn't like one day I just kind of woke up and figured out like what the deal is. So I said, okay, how do I beef this number up? And that's where I kind of came up with this strategy here and how I have to add to my winners over and over and over again and twist and shout that way. So this was integral. I promise you, this was very early on in my career. Like it was Lotus 123 was the spreadsheet. It wasn't Excel. Excel didn't exist. But I really looked at the math and said, okay, can I live with this? And if I looked at the data, what would I have to feel? Because I don't want to get panic struck over stupid stuff like being down 200. The other word I want to define outside of pyramiding being different from just adding to winners is what was I going to say? So pyramiding, first and foremost, again, I know a lot of people are sticklers about this. You want to me, I wanted to add to winners, not to be a pig, but because I needed to grow my account. I didn't have a choice in that, working for nickels and dimes, right? I could get really, really stuck. And that is where I came up with adding to my winners, but then also like adjusting my stops here. I want to emphasize that I don't think that I would think like the move was just getting started. You see what I'm saying? Like I would anticipate this going to 5. That would be the ethos of my mindset. Like I wouldn't think that it would move, right, in just bits and pieces and then stop. I would anticipate it to keep going. And the commissions were too high. Like even for futures, I think it was somewhere between $60 and $100 per contract. So that was quite remarkable in terms of the expense of like being in the business. So I had to really, this. So again, someone said here, Three Kings Media. Thanks, by the way. I see your comments on the channel, Three Kings. Thank you so much. This is emotional, right? I'm having a problem adding when price is above my cost. It's probably because you have a limiting belief that it can only go up so much, and then it's going to stop or stall or pull back. So I realized I had to call myself on my own BS, where like one guy commented on the channel and I deleted it just because it was really stupid. It's like 90% of the time when it breaks out, it pulls back. And I'm like, show me the data, like, because that's not my experience at all, right? If you have hesitancy and you're not getting in at the right breakout point, I guess that could happen. But you know what the breakout point is above and beyond everything else because you can see it. So you could put in your resting buy stop accordingly. That to me shows that the person has conviction. If you don't like those feelings, you're going to miss trades. And I knew I couldn't afford to miss trades. So I had to get to a point where this might be small for some of you. Some of you might be trading more aggressively, but in those days, I really didn't have all that opportunity. There were only a handful of things. And plus the exchanges were in New York. So I could go to down and see my friends in the natural gas pit. I could go to coffee, sugar, cocoa, and cotton, and frozen concentrate orange juice. So I would look at trying to get myself to this point where it might not happen in a day, right? Today markets seem really, really volatile, and they can move. In those days, the markets were a little bit more sleepy, so it wasn't as punitive to kind of take the chart home or take the trade home with you. I couldn't afford to day trade because $100 was a 2% hit to my equity, and that was like the commission on trading, stocks and futures effectively. I didn't really even get a discount. So again, I'd mark everything to the market. I'd see and calibrate my feelings with what it was that I was trying to do accordingly, and then, marry it up with the chart and say, okay, where would I know for sure that the move is over so that I can use effective stop placement to take my profits when the time comes? Because I didn't decide, Blazin. I had to make a damn decision. It was like either do that or not trade. I just came up with a number off the top of my head. I said, okay, I got 5K. I didn't have a lot of money, and I didn't want to take because all of a sudden what happens is when the things work against you, I saw on the charts that what looks like a 3% or a 3-cent stop, because the contract was 5,000 bushels, so the penny was also the percentage. A 1%, a 1 penny move was a 1% move in my account. I had to pick a number out of my back pocket. It wasn't the ATR stuff is many years later. It's many years later for me. I had to pick a number where I was comfortable losing, and then, okay, where could I, because I knew I had a good sense of timing. I really had a good sense of timing. So I figured like, okay, if I know how to use stops, I don't use limits, and then kind of go from there and then experiment and say, okay, I know I could probably over the course of like several months add maybe $500 to $1,000 back into my account. And so I was willing to pay several $1,000s of tuition in the form of losses, slippage and skid and mistakes to learn my craft, right? So that might be what this looks like right here. This whole gigantic structure. I don't know if you can see the mouse, so I'll highlight it. But this is kind of like where you're kind of cutting your teeth. You can see it has positive expected value, and maybe in a day like today, in today's day and age, this might work if you're doing like high frequency trading and there's no commissions, there's no slippage and skid. But this isn't like, I can't grow my account with $30 expected value of a trade. So then even when you start thinking, well, I just sell it 3-1, but now you're still working for, this is blue collar money, right? This is still minimum wage, because even if you're only doing this for 2 hours at the open, 2 hours at the close, you're making the same amount of money that folks in California are making at the fast food quick service restaurants like Chick-fil-A and Five Guys. And I don't want to make blue collar money doing a white collar job. That was absolutely part of the thrust of what I was trying to do. All right. So the risk control, Tim, I see your comment, Tim Downey. Absolutely, risk control. Your job is to play superior defense. All the guys that I know, every market wizard, the whole job, you can be hell-bent for election, but at the end of the day, your gains only look like gains to the extent that you can keep your losses small. So, I don't know. Kyle, I don't know about small caps. Some people, like my friend JC Peretz, is doing analysis on those types of names so that the investment advisor types can watch the maturity of the company go from small cap to mid cap to kind of like large cap and take advantage of that evolution. The theory being sometimes that it's harder for larger cap stocks to make a bigger move because they're already big. Like, how big can they go? But we're already seeing $1 trillion valuations. So I think like you can still swing the big names. You just have to have the account balance, right? You can swing NVIDIA easily. You can scalp NVIDIA very easily. You can scalp Coco, but you just have to have the 30,000 in margin. So let me go back to the show here and say, like, this 450, right, is a 9-cent move in corn, which was doable. It wasn't out of the realm of the possibility of that happening. But that was on one contract. So I said, I need to basically what can I do to increase this number? Presuming that it's going to take me a long while to get a feel so that I could increase my accuracy rate, what can I do to increase my average win and decrease my average losses, right? So this is where I think we're going to make our money today. By adding to my winners, I was getting knocked out of trades frequently, but I'm going to show you something. If I could get this more like to $1,500 because of how I was adding to my winners, right? You can see now the expected value is 510. That's 10% rate of return to my account. Now we're cooking with gas, getting somewhere, but you're also still got to contend with the losses. So if we go back to this, you'll notice where I was adjusting my protective sell stop. I don't say stop loss because when you're making money, it sounds stupid. It's a sell stop order. I don't use limits. There's sell stops and buy stops, plain and simple. The skid isn't going to kill you. You could see I kept adjusting my stops up so that I would get broken even on the last piece. So the way that played into everything was that I would break even about 20% of the time, which is enormously frustrating. But what ends up happening when you do that is you stop losing. I couldn't do a lot. I knew it was going to be an experiential situation to make me learn my craft. You have to be in it to win it. You have to risk losing real money. There were really no places to like paper trade. You could kind of do it, but this was kind of what you're seeing today was my version of doing that. So I learned quickly, like, if I could stop, how do you not lose? Well, you have to be more accurate. But I was like, man, is there a middle ground? Is there something else that I can do? And what I did was I started moving my protective stops up so that I would get to, break even on as many of the contracts as possible. And so that kind of annulled the losses because I was getting knocked out of trades flat. You see? And that increases your expected value because now you're only losing, you're winning and losing with the same frequency. You're adding to your winners, you're letting your winners run, right? This isn't going to work for folks who want to scalp or day trade this because these moves weren't going to happen in intraday. They had to happen over weeks. So by definition, I was taking it home overnight over the weekend. But the main goal was to think about how do you increase your expected value, right? What do you do to increase your expected value? To me, it was get into winners, add to the winners, let the winners run. I don't know where the move's going to end. I let the market tell me what the price is, where it's time to go. And I can adjust my protective stops to break even as fast as possible because that can limit my losers. So that's the sneaky little trick that you can deploy like right now. get your protective stop to break even as fast as damn possible. And if you get knocked out, okay, it's frustrating, but you still have more money in your account, right? So, they say, quitters never win. But but they oftentimes have more equity if you're using. So this is kind of like what I looked at. I knew it was going to come down to protective. I knew it was going to come down to expected values and what could I do to make more money for the work that I was willing to do, because I was already ready, willing, and able, to work hard. And then it's like when I started to put those numbers in and started to think about my goal, I was doing back of the napkin math to say, okay, if I could do this and make 1,500 there and keep this number there and then break even here, it would give me an idea of like what I was looking at in terms of like the number of trades to kind of get where I needed to go. Because some of you are at home, trying to make 250 by risking $50, and it's just not this isn't enough for me to kind of move the needle to make me even want to get out of bed, and that's with a whopping 5-to-1 payoff. So I needed this number to be bigger, much bigger. I couldn't get excited about small gains. You know what I'm saying? I could not. I couldn't get there. Chris, I'm trying to read your question. Is that like an ATR divided by R determining when to get to break even? That I don't understand the question. It's over my head. I wasn't using ATR. This has nothing to do with ATR. This was me picking a number in pennies. What could I risk on corn such that if it moved that amount against me, what was the impact? Again, if we go here, this is what it was about. This is what helped me figure out my position sizing and how much to risk. You see, I would take the open, high, low, close for every day and put it in and then see what was the impact to my account balance before I would get into, the second word that I want to define, which is drawdown. Your drawdown is measured from month to month. If you have 3 losing trades in a row, you're not in a drawdown. You just have 3 losing trades. So some of you are getting a little too uptight about losing money. No hard feelings, but, give yourself, you're too hard on yourself, right? Again, so we talked about pyramiding, which was using the excess equity that increased from your winning positions and then using that buying power to buy more. I wasn't doing that because I had ample cash in my account at say $200, right? If I had 2,500 for margin, for futures margin, I could buy up to 10 contracts and not really use anything beyond the implied leverage that you get with those contracts. So I'll give you that. There's no Reg T loan. There's no day trading buying power. It's all just set by the exchanges. Then the member firms, the FCMs, can either keep it at exchange minimums or they could actually make it more stringent and more expensive to kind of scare out, like in cocoa, right? Cocoa went from about 4 or 5K in margin several months ago to 30,000 now, which means that you scare out all the small speculators to keep the integrity of the marketplace. So that's a big boy market now. Who's there? Well, me, other CTAs, hedge funds, and hedgers. Now, I always figure like I'm the small banana in the crowd because they all have, yeah, but limit moves were so, Tim, I see your comment. Like, again, that's the boogeyman. I've had a couple of moves. Obviously, I was in 9/11. I had investments in 87. Like, they're not the word. I'm not over levered here. You see what I'm saying? Like, I didn't feel like I was anyway. And people kind of put this boogeyman like, oh, I can't take risk home overnight because only bad things happen overnight. And that's not my experience. That someone put that in your head. It says Johnny, and I'm not talking to you specifically, Timothy. I'm just speaking in general that I get a lot of comments like people are afraid to take risk home overnight, but that you're biting your nose to spite your face because the moves happen overnight. And if you catch the trend in the right moment, typically it'll work in your favor and it'll keep going. It doesn't mean that you can't live. I didn't put a lot of them here where there's a tick against you you know. But at the end of the day, it's better. To me, it's much better. If your goal is to grow, see, I wanted to make a lot of money, but I didn't want to have to work like a dog. I wanted to start to think and use my brain. And it made no sense to me because I looked at every position. I looked at every. Yeah, I mean, there's a limit move was 20 or 30 cents. So on corn or whatever. But those to me again aren't those are facts, but that doesn't mean that they're going to happen. I never saw that in the grains in my life. There were times when markets would become illiquid or they would have what's called a fast market, but I always kind of understood because I was I came from the physical side, right? Because Colombia when I was a student was the third. Hang on, let me get off the screen here and go back to my Sony. When I was in college in New York, Columbia was the third largest landlord in all of New York City. So they were very sensitive because they had, there were 7 or so schools under the university umbrella, right? College of Physicians and Surgeon, Dental and Oral Surgery, School of Journalism, Teachers College, Columbia College, General Studies, the Business School, the Law School. I might be missing one or two, but there's 25,000 people in terms of faculty and students across the entire university, and a lot of those folks lived in university, both faculty and students lived in university-owned housing because they owned a lot of property. That's a big part of their endowment actually is owning New York City property. So they were very sensitive to heat and oil and natural gas prices because in New York we have 4 distinct seasons. In the summer, you need natural gas to create the electricity to power all the AC inside the buildings, never mind the houses. And then in the winter, right, you need heat and oil to heat the place. So, and they didn't have a hedging strategy. So yours truly was in the right place at the right time at a damn college work study job to kind of understand and help them create a hedging model. So that gave me experience to understand the physical side of the market, right? Which is really what drives the futures markets, right? The cash market moves first, and the futures market is really an insurance market. It's for risk transference, right? The rules are built for hedgers that we can speculate and underwrite that risk is kind of how we get paid. A lot of crazy people in the media are like, you're pushing the oil market and you're controlling prices and screwing Americans. It's like, no. First of all, OPEC controls the oil market in many ways. So at the end of the day, I learned from the physical side how the market works so that when I went to the speculator side, I did have to figure out position sizing, right? Because hedgers know what their liability is. If Columbia knows that they had to, have XYZ needs, they would buy futures to hedge because they're inherently short the physical that they need. So higher price or price spikes would hurt them because they'd have to go out of pocket in the cash market where they would actually do the deal. Same thing, producers, they're long the physical, so they sell futures to hedge, right? So the concept here, there's 2 functions of the market, price discovery and risk transference. Everything else is bullshit, media stuff, political wars. But anybody who trades commodities knows that cash market moves first and the futures market follows. One doesn't trigger. It's not the other way around. And less than whatever it is, 2% of contracts are actually delivered against, and that's usually you might see that in cocoa right now if there's tightness in supply, and the futures market becomes the supplier of last resort. That's just the way that it goes. So then I would use all this math to kind of figure out, like, okay, on average, like how many trades would I have to get on average, right? But I also had to count in commissions. Today it's very different because your commissions are basically zero or very small. My commissions were 100 times what you're paying. So it was very punitive to think like scalping. That was not going to happen. So I needed these numbers to be gigantic, for what I was willing to risk. And then even as I got bigger, I was like, okay, I'm getting knocked out. So what I'm going to do is I'm going to give this a little bit more. When I got to like 10, 15K, I started to risk a little bit more. but then I was adding more positions so that I could, again, continue to grow, my expected value. That was the goal. That's how I hit my goals, was increasing my expected value. I can assure you, it's not looking at some magic chart pattern, because they don't exist. The chart pattern, whatever it is, cup and handles, head and shoulders, these and those things, you can identify them easily enough. But at the end of the day, it's how you trade it more than anything else. And so when people say, yeah, you can't find 5-to-1, maybe not with one contract, but if you're adding to your winners and adjusting your stops when you get knocked out, you can absolutely skew your winner to loser ratio, to 4-to-1 to 10-to-1. That's something that you can absolutely do. But to try to do it intraday scalping, it'll probably happen because you're in the right place at the right time. And there's nothing wrong with that. We'll take that. Now, what you can do in light of ATR is you can go in and create a spreadsheet for yourself where you have commodity. You can do this for stocks too. I just did this for commodities because I had it handy. And then, here's the standardized size. They're all very different. So you kind of have to normalize the risk. This is something I kind of had to find out the hard way, because I used to just trade, ones of everything. But then when you do start to look at something like ATR, which is subjective in that you choose it, but it's systematized in that you consistently use it across every instrument, you can take into account, like, what's the dollar vol of the instrument that you're trading. So you get a feel. I call this column the personality. This is the personality of the contract. Because you can't look here. You have crude is 1,000 barrels. This is 100 troy ounces. This is 25,000 pounds. Here's 5,000 bushels. So already you have different measurement. You have weight. You have liquid. You have volume, right? So cocoa 10 metric tons, sugar 50 long tons, right? So you're getting into these denominations that can drive you nuts. So then when you multiply it through, you can see what the personality is of the instrument. And then if you choose like what your R is, right, you're comfortable losing 0.5%, then you can see how much of this, right, you can tolerate given this. And you can't have fractions of contracts, so then you could truncate. That's what this is, truncate E7. And then now you can get a better estimation and be more objective and understand that 2 crude contracts, okay, are equal to 4 soybeans, equal to 16 corns, given the prevailing volatilities. So this might be, if you're trying to create tiers for yourself at home, one thing that you can do to absolutely improve your risk management when you look at, trying to position size. You see? But you're going to, I think, do a lot better if you're promiscuous and you look across many instruments as opposed to one, especially if you're looking for your favorite pattern. Because sitting looking at MNQ or ES, trying to uptime and downtime so that you can find your cup and handle pattern when you have 10,000 other instruments that you can find, right? You don't have to trade 100 shares. You can do it. And then, kind of go figure that out and realize, like, then this 16 corn as the number of contracts is still 5K. So it stays within your R. So 16 corn is equal to 5 sugar, given the prevailing volatilities, your account balance, and how much of it you're willing to risk on a per trade basis. That knowing that is powerful, because now you're not stuck guessing and you're staying objective. Right? If you're just shooting from the hip saying, I love NVIDIA, so I'm going to buy 10 calls. I love crypto. I'm not so keen on AMD, because you're playing favorites. That's where bias creeps in. And I was very aware that I could be biased. Then the next thing that you can do, and I'll finish the presentation with this, is like, if you bought 16 and risked 6 cents, right? So the purpose of the ATR then could be, this is now the distance between your entry and your protective stop, if you're going to, in fact, trade the full 16. And if you did the math and you said, okay, I buy 16 contracts, 5,000 bushels, risking 6 cents, you can do the math and kind of see, what that all kind of leads up to and what that calculation is. So you do 5,000 times 16 equals that times 0.06, and you get $4,800. And that kind of comes in and falls within here. Why is it lower? Well, because we're truncating the fractions of contracts. So when you multiply the ATR by the standardized contract by the number of contracts, you're always going to fall within 5K, but that's where you're emotionally and financially okay. So then I learned to mess with the math a little bit because I did have a really good sense of timing. And now you can adjust your positions for volatility when you have more money to do that. So next thing you know, you have, if you cut, there's an inverse relationship between risk and the number of contracts. So if I cut to modify the risk, I could give it actually more room. And if you did the math again, with the multiplier being 5,000, multiply 5,000 by this column, then by this column, you're going to get $4,800 in each and every instance. And then when I got more confidence, I actually went the other way and said, my timing is very, very good. I have to trust my instincts. It came many years later. It wasn't like, oh yeah, I took some guy's course and then all of a sudden I was, Paul Tudor Jones. It doesn't work that way. So you can go and say, I'm going to double my position, but now I have to cut the risk by 3. Again, you might get stopped out on noise because then at that point, anything inside, meaning if your protective stop is less than 6 cents, you might get knocked out because of noise. That frustration doesn't bother me because I'd rather feel that than the despondency of having lost money, for being a bonehead. So you have to honor your stops. In this case, if you're looking at this kind of model, the ATR, like if you were going to short crude at whatever price it is, just make a number up, call it $80, and you were short 2 contracts, risking, your 0.5%, you'd put your protective buy stop at 82.36 on a stop above the market. So if it rallied in your face, you'd get knocked out, no big deal. Take the contracts off. There you have it. Likewise, if you were on the other side of the trade and you were bullish, you buy it at 80, then your protective sell stop would be at 77.64. Sell 2 contracts on a stop. And basically that's all I do every day is I adjust those stops up and down depending where the price action is. And then I just let the market come to me. I never say, oh, we're at 3R, got to take the gain. It's time to go, party's over. Because I'll never make any money. And my goal was to grow my channel quite substantially. So this hopefully there's a takeaway or two for you here just to give you better mindset, give you understanding about how to manage risk and what's really out there in terms of professional risk management, because I see the same bullshit that you see, and I'm embarrassed for the industry. I see some 26-year-old guy talking like he's invented trading about how you can make all this money, and I'm like, man, so many people are going to get effed out of their money on this because it hasn't stood the test of time. And the person hasn't had enough life experience to really know what they're talking about in terms of, being in the market. Try going to bed at night and sleeping with one foot on the floor because there's the Asian contagion. Long-term capital is going out of business. The Thai baht is devalued. Argentina decouples the peso from the US dollar. Like, those are things that you have to live with, and it gives you very, very thick skin. I'll come in and check out a couple of questions here. I don't know if I can scroll. Amanda Castanos, does it translate for options? It can. It depends, though, on a lot of things. Maybe I'll do something on options at another time, but the bid-ask spreads can be kind of wide, right? And that, so depending on how much cash you have, you might find, So going back to that spreadsheet, by the way, if the volatility increased and or your account increased, it might come up with a different number of contracts. So that's kind of how you could trim the hedges. You can sell one, you could add one. That's the benefit knowing well. So that this way you can have, I want to be careful saying this because who knows what it means, but for you, for your tastes and preferences, which tend to be exogenous, you can maybe optimize and just always make sure you're kind of within. It might not happen from day after day. If you looked at this ATR sheet, you could probably update it maybe once a week. I have found that things can change, but not that crazy. Timothy, in your risk, did you ever calculate risk amount and add actual look-back noise? I don't know what that means. Do you mean would I adjust the prices? I would really just use the prices that I saw. I wasn't afraid to lose money. I have a hunch that you're afraid to lose. And if you have that feeling in your body, it's going to prevail in your trading. So you might as well make friends with it because it's not going to go away. And if your account grows, it might actually get worse. I suffered the problem that everybody suffers. Well, not everybody. That sounds political. At the beginning, I would make money from my clients, and I found it very hard to make money from me. Why? Emotional attachment. But I knew in my heart of hearts that I needed to grow my money to have the profound change that I wanted in my life, like giving myself some breathing room, having 6 months of runway, and being able to pay my bills, which, it's just math, like you said. Do I have to pay a funding fee to keep the position? No. Maybe you're answering another question. I hope I'm saying Tio Dereshu, Liviu. I don't have to keep a position to keep it open. There's a maintenance margin, right? So the margin call is the initial margin, and your money has to be in the account. We wouldn't do trades unless there was liquid cash in the account and or treasury bills, because futures margins account don't have a cash money market. That's Reg T, that's equity. Futures margin is just cash, and you don't earn anything on it. So a lot of FCMs, at least the ones that I cleared ED and F Man forever. You could buy treasury bills and then effectively borrow against that because they were guaranteed by the full faith and credit of the U.S. government. So they pay you like the effective rate of a money market, But no, they wouldn't. The only reason the margins would increase is because the volatility of the instrument would increase. And the exchanges use a calculator. It's like SPAN. I don't remember what it stands for. It's an acronym. But they use that to calculate the vol. Also, as the prices go up, you have to understand, like, the margin would double. Like, even if cocoa wasn't so volatile and it went from 5K to 10K, the margin would double just because it's like the down payment of a house. If the down payment's 20% several years ago and your house was 500K, you put out 100K. Well, if the neighborhood starts popping and the house goes to $1 million, it's kind of like the way it goes. You have to put down 20%. So now that down payment is 200K, but it's still 20%, right? So that's what the exchanges, kind of look like. Yeah, so I would basically say I appreciate all the questions. I hopefully get to them. If I didn't, I want to keep this down to about an hour. We're kind of up to that spot. No, Daniel, my wins were, as you can imagine, more home runs. Not because I was swinging for the fences, but because I was adding to my winners, and they eventually became home runs. So you are playing Yankee small ball from like the 1990s. Get on base, move runners, right? It's how UCLA won the College World Series. I don't think they hit a single home run in the entire thing. They had really great pitching with Adam Plutko and Nick Vanderteig, who coached my kids pitching, and Tyler Heineman, who was their hitting coach. He wasn't on the team. He had already been drafted. But so I was hitting singles to get started, but that's like how you have a big crooked number in the inning, if you want to follow the baseball analogy. I wasn't getting up there trying to swing for the fences. I was getting there saying, let me get a feel for the market. Let me add one contract. I'll add another. And sometimes I was adding 5, 6, 7, 8 times if I could, adjusting my protective stop all the way. Because I realized, like, I was a hustler. I had always hit my goals. I always had money in my pocket. And if one of those crazy limit moves happened or some outlier event, that I was going to land on my feet. I always did. I'm self-made, and I've been hustling since I'm 12. So, and I don't take shit from anybody. So at the end of the day, I knew I was going to win. Yes, ACOS, I hope I'm saying, price is your trigger, right? You're not sitting there looking at the chart saying, is this the right time? You have to pick a moment in time, whether that's a 5-day high, a 2-day high, a 10-day high, an 11.5-day high, whatever it might be. I was more thinking about, I need momentum in my favor. I didn't want to buy pullbacks because to me, pullbacks were the beginning of a corrective phase, right? Or weakening momentum. And after diversification, since we're traders, we don't care about valuations, right? Don't let investor talk creep into your trader talk. So PE multiples, if you're looking at Nvidia, or when the what do they say? Oh, we're at nosebleed valuations. I'm like, this market's going to double, because that's no that's not a data point you can use as a trader. You know what I mean? So, or at least I can't. Maybe some of you can, but I don't look at it that way. So, you know, I wanted to be promiscuous. I wanted to build into my winners. There's so much stuff, like there's actually more content on Spotify because the show had been started as an audio show. So there are topics. If you either go to Martin Chronicle, there's a search bar. You can search by topic. You might find that there's an audio only version of something that I've discussed. For example, if you want to go pro and start raising money, there's an episode that talks about how to speak with backers, build a track record, go through the registration. It's not on YouTube, but it's on Spotify because it was months or years before I started, doing the show on YouTube. But anyway, yeah, so basically in moving my protective stop, it was like you have to pick something, and you can't do it with fear. You have to experiment. Right? You have to be a creative person you have to be decisive, you have to be creative. And despite having fear or trepidation, you have to take action despite how you feel. That's probably what I think a lot of you, at least from the comments and the emails that I'm getting, is there's a reluctance to feel the feelings that you don't want to feel. I promise you, and I'm looking you all square in the eye, they're not going away. If you do not make friends with those feelings, they're going to torture you for the rest of your life. And to me, if you can't overcome that, you're not cut out for trading. There's uncertainty. This is about probabilities. You don't have to worry about being right. You have to be right some of the time. That's it. It's really clean, super clean. And just get used to it. Like, it's part of the business. If you want to be a pro trader, losses are part of the business. You can pick a number. Like I picked 2 cents, 3 cents, whatever it was, because it changed depending on my equity and depending on the instrument. I would pick. So if I bought the coin at 430, if it went to 432, I would raise my stop. If it went to 434, I'd raise it another 2 cents. So that it was kind of like I always had that constant risk on. You might try it and see that works. What you don't want to do, and this, I got an email about this the other day. Someone bought something, say, at like $20. Protective stop was at 19. The thing grew to $27, and the original protective stop was in at 19. I was like, you can't do that. You're not there to enjoy the ride. You're not going on, this isn't a scenic tour here through the Canadian Rockies on the train with the glass ceiling. You got to move your stop up. So my thought was, you're like 27. I would have been out at 23 or 24, but you know that you need to make money like right here, right now, but you don't have any idea, because human beings suck at prediction. You don't know how high something can go. I promise you, when Nvidia broke out at 505 months ago, no one knew it was going to go to 1,000. Right? Some people can guess and they go, "Oh, I knew it was going to happen," but they don't know. They're just talking shit. And so I learned that the hard way inside the brokerage office, is that everyone had a different opinion, but really no one knew what they were talking about. And then the research was like the talking piece. Like the research, if you think you're reading Yahoo and wherever to get research, you're really just feeding a bias, I think, in many ways. Especially if you're long something or you want to trade NVIDIA earnings, you're going to be looking for those articles that show a bullish tendency and kind of hype it up like it's the Flavor Flav of the business. West Side. So you want to make sure that you don't fall victim to that and you stay objective. Because at the beginning, you don't know what you're doing any more than I did. But that's okay. You can feel like an idiot. I have pictures of me wearing whale rib bell-bottom shoes. You're never going to see those pictures. And my hair was feathered because it was the 70s and everyone was in love with Farrah Fawcett. I can't help it. But that's the way it worked. So you have to experiment. You have to be willing to lose money. That's the best thing I can tell you, is be willing to lose money, but know where you say uncle. That's the best you can do. Yeah, that's me. I got the clock. I have the clock somewhere. It's in the bathroom, I think. Not that I need it there, but at any rate, I appreciate everybody being here. Yes, Robert, I would stay in the trade and let the market knock me out. Like I would let them, I was having a conversation with the market. That was always my take. And I'm lucky. I'm lucky. I know it. I had a really good feel for things and I understood everything from a sixth sense standpoint. I never took it personally. I knew that it was a business and I ran it like a business. I knew that being in the market could change my life and take me out of like the working class if I applied myself. But I had to be humble. I had to be objective. I had to really look at the data. Someone would say, I don't understand. You talk about not looking at charts and looking at the data. Well, I've been going on for an hour and 20 minutes about looking at the data. This helps you make better decisions, right? At least it seemed natural to me to look at the numbers, right? Yes, I'm going Wednesday. Yeah, classes at 6 and 7. Tonight's a sparring night. My body hurts. Appreciate you guys. Thanks, everybody. Let me know in the comments. I might have to edit this thing because I screwed up. You know, there might be other parts of this video that are being shared, so I might have to have a video editor kind of come in and clip that part out and repost it as a video on the channel, so it might not show up under the live tab, but I'll think about. I don't care about 2 ATRs SD. I don't know where that came from, but your job is to try to calibrate your emotional system with the volatility of the instrument. If that's 2 ATRs for you, that's great. But just know then that you need to see a 2 ATR move in order to make any money. That's why in the coaching, I don't want to talk about this because it's not an advertisement or a webinar. But the first week, we talk about goal setting. Mike, I want you to teach me about commodities and cocoa and all that stuff. We'll get there. That's the easy part. If you don't know what the hell you're doing it for, you're never going to get there, right? I don't want to sound like a Pepperidge Farm, Dr. Seuss commercial, but you need to know what you're working for. I had to pick a number. The smartest thing that I ever did when I went to Wall Street was I picked a number and that was my goal. Because I knew if I had that goal, I could say, okay, I got the 50K. Here's what I'm going to do with it. It's going to give me the feeling of safety. And now that I have a bit of a safety net, I have 6 months of runway and that I could pay my bills. Because I didn't have anybody, I didn't have a trust account, I didn't have any money, I didn't have a funding source, I didn't have a rich uncle, I didn't have an uncle in the carpet business, as the commercial used to be. And then I had to only rely on myself. And I knew that if I made money, it was on me. I knew if I effed it up, it was also on me. I live in a paradigm of personal responsibility. That's my life. That's what I do. I don't mind taking chances because if nothing else I'm going to learn, then I can pivot. Don't sit there and write out trading plans. You know, these online sites where you're supposed to fill in all the things, it's too much. At the beginning, you need to find one thing that works and replicate that over and over and over again. Once you prove that it works, it creates expected value, therein is your trading edge, then you can scale. Don't worry about scaling at the beginning. Worrying about getting your process done. All the goals should be around your process, right? On a probabilistic outcome. So don't get married to the outcomes. Like losing money doesn't mean you're stupid. It just means like, that's the way it went for that particular trade. You can't reverse engineer that and said, oh, I did something completely stupid. Now, yes, you can be reckless for sure, but at the end of the day, I appreciate everyone being here and taking the time. I know there's hopefully this kind of pays it forward in many ways because this took me a couple years to figure out. I know it's simple, basic 4th grade math. But this took me years because it was trial and error, right? I had to invent this along the way. So I appreciate you all being here. You can email me through the site at Martin Chronicle. There's on the contact form. If you have a question, you do not have to give me the backstory because then it's a too long did not read, right? Just send me the question and I'll see what I can do. If you have comments or what have you, you know, you could also, you know, leave them on the channel itself. So I'm going to call it a day here. Hour and 22 minutes. Went a little bit longer, but I don't really watch the clock. I have my stops in. My assistant's been adjusting my stops. If we lost money, I'm going to throw him off the roof of the building. Just kidding. I don't do that. I'm not volatile. I'll give him a spanking on the jiu-jitsu mats. At any rate, I appreciate you all being here. Thank you for supporting the channel. I see all your comments again. It means a lot to me. I'm glad that it's making a difference. I'll continue to try to do so as long as I have the time. There may be a day where I can't do it, but at least the channel will be chock full of valuable stuff that you can use to figure this all out and do it. Remember, experiment and iterate. You have to take chances. It's not a sin to lose money, and it doesn't mean that you're stupid. But anyway, I appreciate you all being here. Thank you so much, and I'll see you